Hey there, welcome to the channel. So today I want to talk about the inflation report and the consequences. All right, so from the BLS, we got the inflation report today, and it was quite a doozy. If we kind of look over here, we can see that our month over month for June was 1.3%, which corresponds to 15%, and the 12-month unadjusted was 9% year over year. So these are some really, really big numbers. Now, what I did is I kind of focused on pulling out some of the individual numbers. And then what I did is I multiplied the month over month by 12 to give us the implied annual rate. Now, if you look at it, so for all items, month over month was 1.3%. The year over year was 9.1%. And then, so looking at the month over month, that implies a 15.6% rate. Now, the food was particularly bad with a 1% month over month, 10% year over year, and the supplies 12% annual rate, taking the monthly. So basically, you have two different things. Like in the month over month is seasonally adjusted. This one is not. Okay, so they're kind of different. There's a little bit different in the numbers, right? So, but I think it's useful to just take that month over month number, multiply it by the 12 months of the year to get an estimate of what that is an annualized rate. Now, energy was really the disaster. 7.5% month over month. And even the year over year was 41% for energy. That's just horrendous. I mean, we are getting to a situation where, like in energy, is that getting to the point where it's almost a hyperinflation? I don't know, but you're talking about 90%. And just for reference, if you had something increase by 100%, it's a multiplier of two, right? An increase by 100% of itself, which means that you've doubled. The price of that doubled. So that means the implied annual rate is that, the price of energy is doubling. So that's incredible. Now, then looking at the core where you take out the energy and the food, it was a lot better. It was at, 5.9%. Now, one of the things we could do, we can kind of look on the chart. And so what you could see here is that the blue numbers are the year over year. So you can see that the year over year came in pretty hot, came in higher than expected as compared to the nowcast inflation. And then looking at the core is the red line. So what's kind of interesting, if we look at this, we can see the red line here. I'm just going to echo it. The red line here actually has inflected slightly. You can see it right there. That red line is inflected. But what's interesting here, and then looking at the blue line here, which is the year over year on the blue, you can see that trying to trace this up, it kind of came off a little bit, but then it's come back up to a new high. So it hasn't inflected. It just took a little squiggle. Now, the interesting part is, so you could look at this and say that, hey, look, core has inflected. It has gotten to a peak. It got to this peak right over here. And now it's on its way down. Now, what you can see is it's coming down, but it's coming down pretty slowly. But, it did peak. But what's interesting now is the nowcast, the green line here. This green line is telling you this is now the current estimate, which is early. So this is the estimate of the inflation for the next month, which is a very early number, but it's interesting. What is it doing? It's now they've actually kind of predicted that the core might be coming back up. Now, keeping in mind that these have not been very bad estimates. I mean, in the big picture, they're kind of, pretty accurate, but they can definitely be off by 1% or something like that. So that's kind of what we see. It will be interesting to tell if we are in a situation where, actually the core starts going up. That would be pretty bad next time, but I gotta believe we're just getting to that peak inflation. It's very hard to sustain this kind of inflation. So let's go look at some other issues. So one of the issues with the inflation is that there's multiple things going on here. And there's the domestic US situation, which is the high inflation that we see, which is actually very low compared to some other countries like Turkey, where things are just out of control. But it's also our high inflation, the Fed is cranking up interest rates to try to, tame this inflation. But the issue is that this has a consequence on the rest of the world. So basically, when you're looking at these currencies, if a particular, and we saw this with Russia, right? When Russia, all these sanctions first came out, one of the things that Russia did is they cranked up their interest rates to like 20%. Now that can be very painful, right? Because like putting your rates for cars and other things up to 20%, the base rate, which would be higher for the actual things, that makes things very expensive. But why do you do that? Well, you make your interest rate high to encourage capital to come in, and you encourage capital. When capital comes in, it will strengthen your currency. Now, this, as far as I look at it, this is not really the intent of the US government. What they really are trying to do is they're trying to focus on, look, just get this inflation down, because it's very bad politically. And we've had like higher, we haven't had inflation like this since the 70s and 80s, where it was really out of control. So we can see that this is getting to be a serious issue. So the multiple, and then you could look at the Brent Johnson view of the milkshake theory and all that stuff going on. And that is strengthening the dollar. So what's happening is there's the strong dollar is, in one way, it's getting a little bit stronger, in part due to the fact that the Fed is raising rates. And recently, the last several weeks, I mean, it's just kind of blowing out. So the dollar is going up. So one of the problems with the dollar going up is that it creates a situation. Now, what's interesting here, looking at the UU up, which isn't perfect, but it's like, it's at pretty much all-time highs. So the question is, we have multiple things going on here, and there's a consequence for the inflation that we have. So first, where did the inflation come from? One of the contributing factors is, if you look back here when they shut down for the cerveza sickness, when that first, and they were shutting everything down, basically they had stimulus checks, all this stuff. And if you look here, they go from 4 million to 7 million in a very short period of time in total assets on the Fed's balance sheet. Now, this represents actual money created out of nowhere. In reality, that's in effect what it represents, because the Fed's assets are what? A lot of the assets are treasuries, mortgage-backed securities. They go and they buy these things. And who funds it? The Fed funds it. So basically, the government says, we want to spend whatever. We want to issue $1 trillion in checks and whatever. So they issue $1 trillion in bonds. Who helps make sure that those bonds sell? The Fed does. The Fed has been buying them, and they buy them, but they also like work through the primary dealer system. But the effect is that this is also a proxy. It's sort of a proxy for the money supply, and we can look at that as well. But so the point is that they've continued to increase the balance sheet this whole time. And even after the worst of the pandemic off, they keep increasing it. And now what's happening is they're finally starting to taper this off. So the point is that this increase in the balance sheet, and we could look at the money supply too, the increase in the money supply as well, those two factors that go together, and that has contributed to our inflation. And now that we have our inflation, we're in this situation where the dollar is going up because the Fed is now being, trying to get rid of that inflation, trying to knock that down. So they're increasing interest rates. That is encouraging the dollar to go up. And this is creating a very difficult problem for the world. So it's not just that you have the Ukraine situation right now. If we go, what's going on in Sri Lanka? Well, if we look at Sri Lanka, we have protesters storming the prime minister's office. They were partying at the prime minister or president's house. I'm not sure their structure or their government. But the point is, why is this happening? Now, with Sri Lanka, there's two things. Apparently, what it turns out is that previously, a couple of years ago, they had tried to implement some green policies where they prevented chemical fertilizer. They were trying to basically ban it. As a consequence of that, food was in short supply. Okay, so not good. Right? Not good. And this was some time ago. Now they reversed it, but it was already too late. So the problem is, apparently with these fertilizers, we are growing a lot of food in areas where there really isn't great soil. And I know this, personally, because I go out to the desert. And if I keep going to the other side of the desert, I get to these areas that are literally desert, but huge amounts of crop, huge amounts of crop. So that desert doesn't have soil. So how do you do it? Well, if you have enough water and you have enough fertilizer, you can grow stuff. And in the climate here in Southern California is very warm. So as long as you can find a way to get water in there and fertilizer, you'll grow crops great. So the issue is when they put all these reforms in, they basically had crop yields drop. Now, the response to that is like, okay, they have to go buy food. Now, what's the problem? The problem is that if you're sitting there and you're Sri Lanka and you're sitting there and you're short on food, you have to get food. So how do you get food? Well, you have to go and you have to buy it. And the thing is, you have to buy it using dollars. Your Sri Lankan currency doesn't cut it. So you send out your dollars and then you get some food back. So, you get some, I'm just going to draw an apple and maybe a corn stalk. So you get your food back. But the problem is Sri Lanka now is the situation has got so bad that they've literally run out of dollar reserves. In addition, it's reported that, their economy has suffered from the fact that they haven't had the tourism. So think about it. If you're a foreigner and you go and you visit Sri Lanka, what are you going to do? Well, one of the first things you're going to do is you're going to exchange for local currency. But the point of that all is usually the way it works. You end up injecting dollars. So Sri Lanka would get some dollars from the tourists going over there. You get dollars from them. Well, what happened is this kind of got shut off. So they didn't get dollars there. The second thing is they had a need for a lot more food. The amount of food, because of their environmental policies, the amount of food they had to bring in, this amount of food was going through the roof. They needed to bring more and more of it in. So they're using up whatever dollars they have. They're using it up much quicker. In addition, then add to the top of it the increase in the dollar. So now at the same time that, the dollar is stronger. So the dollar, yes, will buy more food. But the problem is they have to convert. They have to get the dollars. So what little of their local currency, and I'll call it the psi, is that Greek symbol psi currency, they have to switch it over. They have to exchange it for dollars. And their currency has been going through the floor. And even if it isn't going through the floor, because the dollar is stronger, it's stronger relative to all these currencies. So now the problem is with their currency, they get less dollars and they're able to buy less food. So all these things are going at the same time, in addition to the fact that the price of the wheat that they're trying to buy, not really apples, but definitely like the wheat and the corn and the other foods, those are also going through the roof. So they get less of it. And so because of all that, you have this problem with Sri Lanka. And it's just the canary in the coal mine, and it's continuing. So what I'm pointing out in this video and trying to explain is that there's a relationship between what's happening in the US, the fact that we printed all this money, the Fed monetized all that debt, that has caused our high inflation, which is now the Fed is reversing and trying to crank interest rates up. There's even talk of going a whole 1% at the next meeting in a few weeks. And the consequence of that is the dollar gets stronger, the demand for dollars gets stronger, which exacerbates all the issues that Sri Lanka and all these other countries have. So right now, we are in a George Gammon doom vortex right now. And it's very unfortunate. Hopefully it will get better at some point. If the inflation comes down, then the Fed can lay off raising the rates, and then maybe the dollar will stop being so strong. Now, one more thing I want to look at. So looking at oil to try to get a feel for where this energy inflation is coming from, if we kind of look here in the red, this was the previous month. So what they're doing is they're coming there and averaging, and they're getting some number. They're getting a price number, some kind of number, a P1. And then over here, you can see that it was higher for part of the period, but it also did go down in the green period. And this was what was just reported. This is what was reported today with those high energy numbers. So you can see that from P1 to P2, depending how you're averaging, most likely the prices went up significantly, right? We definitely have an increase in price going from there. But what we have right now is as it stands right now, the price has gone down. So there could be a significant relief in the inflation. If oil trades, if it just even trades in this current range for the rest of this month, which I don't know if it will. Right now, it's in a range between like 78 and 70 on the USO, corresponding range on West Texas Intermediate, but that is significantly lower than what it was in the current quarter. So depending how this works out, it is possible that we could be in a situation where this would give us some relief, and it wouldn't necessarily give us a deflation, but it could give us disinflation, which would be a lower rate of inflation. I mean, just looking at this right now, any way you average the P1, what we just had, to where we're averaging now, it should come down significantly. I mean, if I picked an average of 86, we're down at 76. You know, you're $10 off relative. So that's significant. So there may be relief coming in the future. So in summary, we had a really crappy inflation report. Just keeping in mind that it's not only a domestic issue. This is affecting, you know, the whole world because the US is the reserve currency. So it's something to keep in mind. Hopefully, the Fed will get this under control. We'll see if they do like a full 1% interest rate rise. That might be required and the market might not care. So we'll see about that. All right, that's it for this one. Talk to you later. Bye.